Joining us now from Singapore, Mikio Kumada, the global strategist at LGT Capital Management. Quite contrarian views. You're saying that, in fact, clearly from this, that the Chinese and Asian growth will be bigger in decline than the US and Europe. What's your reasoning for that?
Well, in marginal terms, it should be if things go badly wrong in Europe, especially Europe being the largest export market for China and many other Asian economies. What it means is that basically the export industry, from an Asian perspective, offers negative operating leverage. So if you take out the demand out of Europe, then you will have a much bigger marginal decline in the Asian economies than you will have in Europe, which is, of course, is not growing much in the first place. So that is a big concern in the short term.
And you say that the reserve requirement ratio cut by the Chinese central bank, you say policymakers are getting nervous. How nervous are they getting, and what are they getting nervous about?
Well, they are between a rock and a hard place, because on the one hand, they now see the risk of a significant decline in demand, probably mostly out of Europe, as the US is actually holding up quite well, at least in relative terms. And that's, of course, not good for growth. On the other hand, they still have an inflation problem, so they're, a little bit stuck between these two things. And they are trying to put some more additional insurance to avoid a hard landing. It's going to be very difficult, I think, and very challenging for them. They have to do something, obviously. Keep in mind that this 50 basis point cut translates into roughly $60 billion worth of liquidity that can be added into the Chinese domestic economy through credit. But there's been a credit bonanza in 2008, 2010. So the question remains whether in the short term you can actually do much to force feed growth. There's only so much growth you can add in the short term when things are going the wrong way.
And within that, Chinese stocks are 50%, you're saying, below actually the levels they've seen before, whereas US and Europe is 20% below. Also point out the valuations are very low. Many are getting quite tired, to use your words, of being shorter, underweight. Tired, but they're quite safe, aren't they, to be fair?
Well, yes, and that actually makes good sense to be cautious in this environment. However, the paradox is, in market terms, a lot of the bad news in China is actually, you could make a case that more of the bad news is priced in Asian stocks, or in Chinese stocks at least, relative to what is priced in possibly in Europe and the US. So maybe for the short term, with moves like the global joint intervention of central banks and the Chinese reserve cuts, we might have some room for a short-term rally, call it a Christmas rally if you like, but my case is that it remains to be seen whether that is really anything sustainable.
Time is against me, but I must ask a quick question. Bond auctions in Europe, you're saying there's too much noise surrounding the individual auctions.
Yeah, absolutely. I mean, the problem in Europe is a structural one, and any individual bond auction, whether it goes well or goes less well, doesn't actually change that. We will need time. Most importantly, we will need decisions in terms of fiscal union, in terms of Eurobonds or joint liability bonds, before the market can gain any real confidence that Europe is coming to grips with its structural issues. And that's going to take some time. The individual bond auctions in between, they are perhaps worth, to be traded, but, they are forgotten 3 or 4 days later.
Thank you for joining us, Mikio Kumada, the global strategist at LGT Capital Management.